Liquidity and Funds Transfer Pricing, FTP explained. In the world of banking and finance, liquidity and funds transfer pricing, FTP, are critical concepts that play a vital role in shaping the functioning of financial institutions. In this video, we will explore what liquidity and FTP mean and how they are interconnected. Understanding liquidity. Liquidity refers to the ability of a financial institution to meet its short-term obligations without experiencing significant losses. It is crucial for banks to have enough liquidity to cover customer withdrawals or demands for funds. Adequate liquidity ensures that banks can continue operating smoothly and fulfill their financial commitments. Liquidity management. To effectively manage liquidity, banks employ various strategies. They establish liquidity frameworks and risk management practices to ensure they have sufficient funds on hand. This involves balancing the inflow and outflow of funds, monitoring cash flows, and controlling risks associated with liquidity mismatches. Funds transfer pricing, FTP. Funds transfer pricing, commonly known as FTP, is a mechanism used by financial institutions to allocate the cost of funding and assess the profitability of various business lines within the institution. It provides a framework for determining the price of funds transferred between different units or divisions within the bank. Role of FTP in liquidity management. FTP plays a crucial role in liquidity management, as it helps banks assign an appropriate cost to liquidity. By valuing the cost of liquidity, banks can measure the impact of liquidity on profits, encouraging better resource allocation and risk-taking decisions. FTP acts as an internal tool that aligns the institution's objectives with its liquidity requirements. FTP Components. FTP consists of various components that aid in pricing funds transfers. These components include cost of funds. The cost of funds is the interest rate at which a financial institution borrows money to fund its activities. It is a significant component of FTP, as it serves as the basis for pricing funds transfers between different departments. Market rate. The market rate represents the prevailing interest rate for borrowing or lending funds in the market. Financial institutions use this rate as a benchmark to determine the pricing of funds transfers. Liquidity premium. The liquidity premium is the additional cost associated with holding liquid assets to cover unforeseen liquidity needs. It factors in the potential losses incurred due to the illiquid nature of certain assets. Tenor mismatch. Tenor mismatch refers to the difference in the maturity periods of assets and liabilities. Banks consider this mismatch when pricing funds transfers, as longer-term funds are generally more expensive than shorter-term funds. Credit risk. Credit risk refers to the probability of a borrower defaulting on their debt obligations. Banks factor in credit risk when pricing funds transfers, ensuring a fair assessment of the risk associated with providing funds. Benefits of FTP. Implementing an efficient FTP mechanism offers several benefits to financial institutions, including enhanced liquidity management, transparent and consistent transfer pricing, improved profitability assessment at different business lines, enhanced risk management practices, better alignment of pricing decisions with the institution's overall objectives. Conclusion. Liquidity and funds transfer pricing are vital concepts in the banking and finance industry. Understanding liquidity and employing a robust FTP framework is crucial for banks to effectively manage their liquidity, allocate funds appropriately, and assess the profitability of their different business lines. By implementing effective liquidity management and FTP practices, financial institutions can make informed decisions and navigate through the dynamic world of finance with confidence. Want to learn more? Claire Trifle on LinkedIn.